Welcome back to Businessline and this segment of the show where we look at how you can invest your money wisely in mutual funds. Aarti Krishnan, research head of the Businessline newspaper, has been sharing her fund of knowledge on the topic with us over the last few weeks. So Aarti, what do we have in store for today?
Good to be back, Rajiv. Last time we discussed a lot about how you demystify some of the jargon relating to mutual funds. This time there are a few more terms that we can discuss.
So Aarti, I've often seen ads across the newspapers about NFOs. What are these?
NFOs seek to solicit your money for some investments in new sets of securities which may already not be available with the existing open-end funds. NFOs are typically open for a limited period and an investor can seek to invest his money at par during that period. Later the NFO will open as an ongoing investment for an investor to participate in it.
So for some reason to a layperson like me, it sounds very similar to what IPOs are.
Yeah,
how are they different?
Yeah, many investors do confuse NFOs from funds with IPOs, but there are several differences actually. In an IPO, if you see, a company with a financial track record tries to obtain funds from the public to fund a project or any scheme that they have in place. Whereas an NFO is a fund seeking to start from scratch on a particular investment theme. Compared to a plain vanilla equity fund, NFO may offer something like investment in a commodity market, investment in an infrastructure theme or things like that. Because most funds by today have a fairly large variety of schemes already at their on their portfolio. They try to offer new types of schemes which investors may seek to invest in. There are several other differences. Typically, investors look at NFOs and try to make listing gains from them like they do with IPOs. But NFOs may not deliver those kind of listing gains because listing gains from IPOs typically arise because when a company is underpriced during the IPO, when it is actually listed on the stock market, you will make a gain on that. NFO is starting from scratch. So how it performs when the NAV reopens depends on how the market has moved in the intervening period.
Great. Now let's also take a deeper dive into that differentiation there. When an IPO is being offered, usually that's the initial public offering for a particular stock. The underlying value is the valuation for the company that you're buying an IPO for. What's the underlying value of a fund and how should I look about evaluating NFO?
That's why when you start with an NFO, it has no underlying value. It is just a kitty of cash which the fund manager starts with and then he is going to begin investing in securities. So how do you really evaluate it? You have no financial track record or a business or a project to evaluate. So how you evaluate an NFO is based on several factors. The first thing would be the track record of the fund house itself in India. I mean, how have its other schemes performed? Have they managed to beat their benchmarks? Have they done better than their peers and so on? The second thing would be the track record of the fund manager who is going to manage your funds. Has he managed to be skillful at beating the markets over the last 5 years? The third thing would be what is the theme on which the NFO is being offered. As I told you, there are already 250 open-end schemes in the equity space which are there vying for your money. So what should make you go in for an NFO is a unique theme. Suppose the investment proposition that the NFO is offering has not already been offered by an open-end fund, then you can go in for the NFO. For example, some of the interesting NFOs that were there recently was a credit opportunities fund, something like a junk bond fund where this particular NFO invests in bonds of companies with slightly lower credit ratings. Or there could be an NFO of a fund which plans to invest in overseas securities. Now these are not themes where you will find a large variety of funds already on offer. So an investor can go in for these kinds of NFOs.
And if I can summarize that, what we are saying is if you're looking at an IPO, you're valuing the underlying assets of the company, its future cash flows. When you're looking at NFOs, you're basically valuing the credibility of your management, their past experience, and their uniqueness in what they represent. That's very helpful. Let's also look at who should buy an NFO.
Typically, an investor who has a large portfolio of funds already, he should be very careful about adding new funds to that kitty because tracking a fund is not an easy business and any portfolio of funds does require frequent monitoring in order to see whether the fund is performing in relation to peers, how it's performing in relation to the benchmark and so on. So it's a good idea not to keep on adding NFOs, and every NFO that catches your fancy, you should not add it to your portfolio.
Arti, you just mentioned benchmark, and how do we compare an NFO's valuation to a benchmark? How do you establish that benchmark? Where is that benchmark?
The benchmark is usually disclosed by the fund itself. Typically, when the fund makes an NFO, SEBI requires a certain set of disclosures to be made along with that, where the fund is going to invest in, that is the fund objectives. Then what is going to be the investment universe of the fund. Typically, you will find statements like 90 to 100% of the portfolio will be in equity instruments, or 35% of the portfolio will be in overseas securities. Now, these kinds of statements help you gauge where the fund is going to invest and how that gels with your own preferences.
So Arti, let's also look at the offer document. I know NFO is now a new fund offer.
Yeah.
That much I understand. I'm sure that offer comes as a document. If I'm looking at a new fund offer document, what are the things I should be looking for?
It's a fairly comprehensive document. NFO documents actually give you a good idea of what you're going to invest in, who is the fund manager, what are the fund's objectives, and also I asked you to check out the track records of different schemes managed by this fund.
Yes.
Now you will find that in the offer document. The offer document is also supposed to disclose the expense structure, the charges that can be levied on you when you invest in the fund, various other details about how long the fund house has been in existence in India, who are the sponsors, and it's good you go through that. Actually, typically what happens in India is that investors just have an application form where with those little boxes where they just fill in their names, addresses and so on, and even the agent does it for them sometimes. They just sign it off and give it. I think an investment decision has to be made more carefully, so a reading of the offer document is certainly necessary.
Thank you, Arti, for demystifying NFOs. We covered a lot of ground today. Let's put a pin into the jargon. We'll come back for more next week. Stay tuned. Don't go anywhere. We'll be back with more.
Coming up, Rajiv Lulla in conversation with Mr. Sivakumar, Managing Director of Sales and Marketing, Intel South Asia.